When you look up how to read price action as a beginner on the internet, you will almost certainly come across concepts that already require a certain level of experience to fully understand. That is why in this ultimate guide, you will learn how to identify market structures even if you have little to no knowledge of charts, how to determine new trends and trend reversals with pinpoint accuracy. As a result, by the end of this video, you will never look at your charts the same way again. Let's get started. How to read price action of market structures. The truth is that identifying and plotting market structures takes practice. However, it is the most fundamental yet critical skill you must master in order to read price action. You may be asking why? Because this is the foundation for identifying trends, patterns, and identifying where to set your take profit and your stop loss and lots more. So here are some market structure terms you should be familiar with. Higher high, higher low, lower high, lower low. Feeling lost? Let me explain. Higher highs and higher lows. To put it more simply, higher highs on your chart are peaks that are higher than the previous peak. Higher lows, on the other hand, are bottoms on your chart that are higher than the previous bottom. I'm sure you're curious. How do I know whether it's a valid higher high or a valid higher low? Good question. And pay close attention because this is going to be crucial. If the market rises above its previous high and then falls, then you can think of it as the current higher high. Alternatively, if the market is currently declining but has not yet surpassed its previous higher low, it can be considered the current higher low. Again, it is still a valid current higher low as long as it does not fall below the previous higher low. Do you understand? I hope so. But the question is, what happens if the current higher low falls lower than the previous higher low? The answer is that the market structure has now been broken and the market is now referred to as a lower low. Keep watching and I will tell you more about it. Lower lows and lower highs. In contrast to the previous market structures, lower lows are bottoms on your chart that are lower than the previous bottoms. On the other hand, lower highs are peaks on your chart that are lower than the previous peaks. Now, if you have been asking the question, when do we exactly know when they happen? Now, that's a valid question. It's a valid lower low if it closes below the previous lower low. Right, the answer is right. But however, new lower lows can also happen once they exceed below higher lows. On the other hand, lower highs can repeatedly happen even though no new lower lows are made. With that being said, let's do a little bit of an exercise, shall we? Looking at the chart on the pound USD on the 4-hour time frame, I would like you to identify current and past higher highs, higher lows, lower highs, and lower lows without taking the video back, but you can pause the video and do this exercise. Ready? Let's get started. Now, I know that there's a high chance that what you have plotted won't be the same as mine, but that's okay because two traders can see different things, yet both can still be correct. For example, these market structures are also correct. Does that make sense? Okay, cool. The question in your mind right now might be, but how can I use this concept to actually trade the market? So moving forward, I will teach you how to read price action of different market conditions, when they start, when they can potentially end, and how you can identify both. Just keep watching. Market conditions, what they are, when to define them, and when do they end. I'm sure you have already heard before. An uptrend consists of higher highs and higher lows. A downtrend consists of lower highs and lower lows. Finally, a range is when the price is contained between two highs and lows. However, the critical question not many would dare to answer is, when exactly do trends start and when exactly do they end? Let me answer them for you right now. Uptrend. In terms of market structure, a valid uptrend is when the price makes a second higher high, which indicates that price can potentially go higher, while an uptrend is invalidated once the price exceeds and closes below the higher low, therefore making a new lower low, which indicates that the price can potentially go lower. Downtrend. If we look at the previous chart example, is it already a valid downtrend? The answer is no, because unless the price makes a second lower low, there is a chance that the price can reverse back and make a false breakout. But once it makes a second lower low, it will indicate that the price can potentially head lower. On the other hand, a downtrend is invalidated when the price exceeds and closes above the lower high, therefore making a new higher high, which indicates that the price can potentially go higher. Range. Recall, a range is when the price is stuck in between the highs and lows. But the truth is that many things can happen between those highs and lows. That's why a range market can come in various forms, which we call chart patterns. Nonetheless, a range can be considered valid if it retests the previous high and low once. So, when is a range invalidated? Beautiful question. It's similar to how we confirm trends when it makes a second higher high to confirm a new trend. For example, you might be thinking why a range isn't invalidated when it makes a new higher high. It can quickly go back into its range and become a false breakout and become the new range high. At this point, I'm sure you will notice by now that everything we have learned up until this point thus far complements each other. As always, if you found any value and learned something new, please give us a like to assist us with the algorithm, and make sure you hit the notification button to stay in touch whenever we release a new video. Until next time, cheers and bye bye.